Good morning, everyone. It's great to see so many of you joining us again this morning. We have opened the virtual doors on today's webinar, and I can see that there are large numbers joining. So I just want to give everyone a couple of minutes to get in and get settled. You can potentially grab a couple in the next minute and a half before we kick off. Great to have you with us. Okay, good morning and a very warm welcome to you all. It's great to see so many of you returning to today's webinar who were with us in part one. It's also great to see many new faces. My name is Caroline Preston. I'm the Business Development Manager in PKFFPM and I will be your host this morning on this part two of InterTrade Ireland's COVID-19 webinar series. We have another great session lined up with you with great speakers in today's session, and we're looking at the topic of cash flow management and funding in Northern Ireland. But before I hand over to Shane O'Hanlon from InterTrade Ireland to formally open today and introduce our experts, firstly, may I quickly do my Zoom host introduction and highlight a few points that you should all be aware of. Today's session is being recorded in order to make it accessible to both you and to others on InterTrade Ireland's website following the event. Please do keep this in mind when you're asking any questions of a sensitive nature. Our question and answer session will take place after our presentation this morning. So if you have any questions for our experts, please go ahead and submit these in the Q&A box just at the very bottom of your screen. This can be done throughout the session, just as and when the questions do come to you. Then when we come to the Q&A session, I will enable your mic and call upon you to ask your question directly to our panel. The final thing to say is that we can't see you and we can't hear you until I bring you in individually at the Q&A. So hopefully that will provide some clarity on today's session and really help to make it really interactive. So without further ado, I am going to welcome Shane to the floor. Shane, good morning. I am going to hand over to you.
Brilliant, thank you, Caroline. Good morning, everyone. So on behalf of InterTrade Ireland, I'd like to welcome you on to the webinar this morning. This morning's is the fourth in a series of 6 webinars, 3 specific to Northern Ireland and 3 specific to Ireland. They're proving very popular and they're designed to help businesses navigate their way through the key supports that have been put in place in both jurisdictions in response to COVID-19. Those of you that were on last week's webinar will know that we focused on the financial supports that have been put in place. This morning's session will look at cash flow management and the funding piece. Fergal will cover business continuity planning, core funding principles, cash flow management, and how to approach your bank or other funder for support. But before we get started, I'd like to take the opportunity to bring to your attention some of the supports that InterTrade Ireland have recently put in place to assist businesses during these uncertain times. So apologies for those that have already heard me through this on our previous webinar, but I think it's important that I just take the time to even just to reinforce it. So eMerge offers up to £2,500 fully funded consultancy support and advice to help your business develop the ever more important online sales and e-commerce solutions. Emergency Business Solutions, meanwhile, offers up to £2,000 fully funded consultancy support and advice to address key business challenges, including cash flow, human resource issues, and supply chain. Now, with both these offerings, there is eligibility criteria, but criteria remains the same for both. Company is a manufacturing or tradable service business registered on the island, must have a satisfactory trading history, be engaged in cross-border trade, as you would expect from InterTradeIreland, the cross-border organisation, has the capacity to deliver the project over the next number of weeks, and is an SME in that has less than 250 employees and an annual turnover of less than 40 million. Additionally, InterTradeIreland have produced 2 excellent resource documents that I would like you to take the time and access. These are very much complementary to this morning's session, one specific to Northern Ireland, the other Ireland. They're available on our website and they summarise a lot of the key information you and your business ought to know. Finally, alongside TAC Ireland, we've developed and created an online platform in the form of an interactive map, which allows businesses to see who they can work with to combat the many supply chain and manufacturing challenges generated by the pandemic. With all these supports, again, I would encourage you to look at our website, intertradeireland.com. Before I hand over to Fergal, I'd just like to say a couple of very quick thank yous. Firstly, to 2 people I know well, ex-colleagues in fact, Mark Sturrett, the UK Network Director with the British Business Bank, and Geoff Sharpe, Head of Corporate Banking at Danske Bank. Thanks a million, guys. Your help this morning is greatly appreciated. Also, Fergal and his team at PKF FPM, most notably Michelle and Caroline, for helping put these webinars together for us. They've proven to be a great success, and I hope you get a great deal out of this morning, and I encourage you to get your questions ready. So that's enough from me. I'll hand you over to Fergal.
Shane, and when we're setting up the slides here, I just, as Shane has said, my name is Fergal Cormac and I'm Managing Director of PKF FPM. We have 5 offices across the island, and we're really honoured to be invited by InterTradeIreland to help them deliver their webinar series in response to the COVID-19 and the crisis causing among the business community. I'm delighted to be joined this morning by 2 colleagues for the question and answer session, Michelle Hawkins and Amy McShane. And I have to say, we're very encouraged by the very positive feedback which we received from the webinar 1 in the series, which, as Shane has already said, focused on insights into COVID-19 supports for Northern Ireland businesses. Now, it's fair to say that this week's webinar 2 will build on the webinar 1, and this week's series is looking at cash flow management and funding. And initially, we look at the context and then different types of funding and the importance of appropriate debt structure. We look at cash flow management, and finally we'll touch on preparing a bank proposal, incorporating a cash flow forecast. But a lot of what's involved in the bank proposal would be similar to other proposals. Now, we're honoured to be joined this morning by Mark Sturrett, the UK Network Director for the British Business Bank, and also by Geoff Sharpe, the Head of Corporate at Danske Bank here obviously in Belfast. And I would just like to highlight at the outset that my slides are an aid memoir. I'm not going to speak to every slide in detail, but the more important thing is that they stand together as a single unit, and they're available after this webinar, along with a video of the webinar on the InterTradeIreland website. So without further ado, I was still going to say we'll try and make a start here. I've had a slight problem, but hopefully the technicalities will come over quite quick. My slides are not moving along, but I'll keep talking about context, and maybe we'll get the slides sorted in a second. Obviously, as the government in London and the Northern Ireland Executive plan out a course for the reopening of the economy and a phased stepwise approach, business continuity and cash flow plans for Northern Ireland businesses across a range of activities and business sizes will become more and more into sharp focus. And a huge effort will be required to boost consumer confidence, as, to be honest with you, citizens remain uncomfortable from a health perspective of returning to business. For businesses, most of whom have experienced either a cessation or a significant drop in business. There's no blueprint, and any of us who thinks there is a blueprint or a straightforward roadmap to address these issues, I think are simply wrong. But what we are finding is, as businesses are starting now to contemplate the recommencement of trading, that they are getting more and more into the form of business continuity plans. And in that context, last week we were very encouraged when we did a poll in the webinar one, that 54% of businesses in Northern Ireland had implied that, thank you, working now, had implied that they actually had started the process of business continuity planning. And it's fair to say that a business can't just open its doors and start again. It will need a business continuity plan. And liquidity will be key to reopening for business. Research has reaffirmed that planning for and implementation of an appropriate level of liquidity will be crucial in defining the success of business recovery in post-pandemic Northern Ireland, and indeed the island of Ireland. And that's based on previous major global recessions. Now, naturally anticipating future market conditions and customer behaviours and attitudes will be pivotal to success, as will obviously the labour resource, the availability of it, what's also required. And most importantly, I think we should never forget that most business is about talent management. So a new business landscape is evolving with expected changes in market and consumer behaviour and attitudes, and we'll all have to learn to do business in different ways. As a result, we will be focusing our attention on re-engineering our business model going forward, re-engineering perhaps in the terms of the 3 C's: reset, refocus, and rebound faster. So this week's webinar, as I already said, will basically focus initially on preliminary business continuity planning. It's fair to say to do that, you have to also have an awareness of broad business planning, but we'll focus on that more next week. Core funding principles, cash flow management, and approaching the banks, etc. And as we've said before, a business can't just open their doors and start again. They have to plan the restart and reflect changing circumstances. It's all about agility within your business model, and then taking into account that such changes, as we're all now aware of, the social distancing requirements that are emerging every day virtually, which will be required for us to implement in the short to medium term. The businesses must ultimately ensure that they have enough cash to pay the wages at the end of the week and the end of the month, enough to pay suppliers at the end of the month, and don't forget, always remembering to keep hopefully something left over for the owners to live on themselves. So it's also fair to say that a crisis is a very good time, particularly if we've all been paused for a little while, and everyone hasn't been, by the way. Some businesses have been doing very well, food retail and those serving the health sector. But for those of us who have had been a little bit of a pause, it's good to take a holistic look at the business. And business, I would suggest, should review their products and their services, perhaps adjust prices, indeed product and service lines and delivery challenges. But across all of this, if the business does not have a strong financial planning and liquidity base, unfortunately, it is most likely destined to fail. Now, there's no reason to panic because this is where we really build the confidence in our team and in our agile strategies. But it's important to equally acknowledge that our present circumstances don't determine where we go. They merely determine where we start. We think about it, Obama started in very humble settings and finished up in the White House. But it is equally important to acknowledge that if you don't have a destination, you'll never get there. If you and I didn't decide to be in this webinar this morning, we wouldn't be here. So the future does belong to those who plan for it. And failing to plan is planning to fail. And, perhaps even for us accountants, we have to really learn very quick that analysing the past is not what this is all about. This is actually about designing the future. Design means, if you think about it, putting things together to deliver a value-added solution to meet and hopefully indeed exceed our clients, our customers' expectations, and thus deliver market differentiation and a competitive advantage. Now, I'm a great admirer of John Wooden, and I think he said one very important thing which I always focus on. How you run the race or your planning, preparation, practice, and performance counts for everything. Wait for it. Winning or losing is a byproduct. It's an after effect of that effort. Now, I think that's really important. And believe it or not, he never, in a dressing room, before his team went out, he never said win the match. He said get the performance right. And if you get the performance right, 9 times out of 10, you will win the game. And really what he was saying was, it's a very important lesson for us all, never cease trying to be the best that we can become. And as I said, next week we will be focusing on the recovery planning. So I'm not going to go into this in much detail today, but it is important in terms of your continuity, your business continuity plan, to be aware that you start with a baseline, you then go on to SWOT analysis, including PESTEL, which is for opportunities and threats outside your control, political, economic, social, technological, environmental, and legal matters that you see, how do they impinge upon your business at present. You're generating ideas, you're evaluating those ideas, and then you're developing a plan and milestones. But most importantly, it doesn't sit on the shelf. You're managing, monitoring, and adjusting it, looking at actual against forecast performance. Now, certainly a business does need direction, and certainly if a bank is looking at a business continuity plan, it will be looking to see that the business is got forward direction in its mindset. And to facilitate business planning, we have developed a strategic management, a holistic tool, very simple. You do it in the back of an envelope. We call it the rocket. It doesn't need to be a big plan, but you can see there is strategy to it and there is structure to it. And what it really means is that obviously initially the strategic plan determines your vision. And then once you have your vision, your business plan accepts that vision and as it is and revisits it the best way to achieve it. And the business continuity falls within this, where you highlight your strategy, your structure. Your culture is most important. That's the DNA. That's the glue that links everything together. And again, not for today, more concentration next week, but in our view, there are 5 core operational areas that you must address in a full business plan, some of which will be relevant in your business continuity plan. The most important thing to pick out today is that planning is needed for the funding and cash the business requires, when it requires it, very important, and where it will come from. And all of this must be underpinned by a risk assessment, forensic and sensitivity analysis, managing expected receipts and payments, inclusive of any estimation errors. And that's naturally the way we, none of us can forecast the future with any certainty. However, the strategy for commercial revenue will vary depending on the activity sector, the size, the product or the service that a business is offering. However, I think this is important. I believe, an old mentor, and the more I continue in business, the more I'm convinced he's right, that if you take the skins off most businesses, they're actually very similar. And there are many aspects of financial planning in these unprecedented circumstances that all businesses will need to consider. And really, that's what we hope to focus on this morning. And first of all, the first thing I'd like to highlight to you is that instead of jumping for funding, pause for a second, because it's very important you identify what is the cause of the funding requirement. Why do you need the funding? Because that's very important to choose then the appropriate form of funding. But to ask yourself the key question, what are we trying to fund? Is it funding financial losses or cash losses, sorry? Is it working capital, capital investment, R&D, or international trade? Any of these things, then you'll be better positioned to choose the right form of funding. Now, there are various forms of funding, and there's a few we focus more on because they're the main ones today, but we'll highlight the breadth of them in this slide. It's fair to say that cash flow within the business can be supported by seeking an extension from creditors, an extension of period, paying the creditors, or indeed negotiating reductions of outstanding debts, and many have done that already. But also remember, refinancing of existing unencumbered assets or selling assets you don't need, surplus assets, can also be a help. The rest of the forms of funds on this sheet, to be honest with you, we're going to cover in forthcoming slides. So if we just keep moving on, I think at the outset it's important to understand, and again, this is important, in any form of negotiating, you always got to try and put yourself in the position of the person on the opposite side of the table. And in terms of types of funding, it's important to appreciate the risk-reward dynamic. And the truth is, the higher the risk, the greater the reward is equity. But the lower the risk, then the lower the reward. But then you have to be careful that you don't ask a debt provider to provide funding for risk, because that is not their responsibility. They're only getting a fixed return. So in terms of bank funding, it's fair to say there are probably 4 core elements of bank funding. You have working capital funding, which is your overdraft, your invoice discounting, your stocking facility. You have asset-backed finance, which is your hire purchase, your lease financing, your chattel mortgages, you have business growth, and you have specialist funding. Now, in terms of grant assistance, and again, to be honest with you, this could take up an entire webinar on its own, so we don't plan to go into detail today, but obviously you have the COVID-19 supports and unsecured loan assistance, which we went into in detail in our last webinar, you have various grants available from Invest NI, marketing, training, employment, R&D, capital, etc. Then you have other organisations like the Arts Council, the Big Lottery, the Community Federation, Heritage Lottery Fund, etc., Northern Ireland Screen, which may be relevant to your business or your sector. And for many in the agri or in some form of food business, environmental businesses, it could well be that the Department of Agriculture, Environmental and Rural Affairs could be a source of revenue. Now, just at present, unfortunately, the RDC programs are currently closed, but they will reopen again. You obviously have the important local enterprise agencies, local district councils in terms of mentoring, etc. And then the cross-border assistance, which Shane has already covered in terms of InterTradeIreland, both in Shane highlighted the COVID-19 programs, but equally InterTradeIreland have a very good, very attractive suite of proactive programs to help business. Now, in terms of venture capital and business angels and EIS, just to give you a brief overview of what these things are, because you're probably hearing them, and sometimes it will be appropriate to your business. Venture capital provides long-term monetary investments in exchange for equity in a business. It is a form of risk capital, the most form of risk capital perhaps. And unlike bank debt, it is no guarantee of repayment or interest. Now, it's fair to say that the majority of venture capital firms, they target businesses requiring over £150,000, and they're mainly involved in expansion stage companies or managing buyouts or managing buy-ins. On the other hand, business angels tend, and are more relevant to the SME sector, business angels tend to invest between $15,000 and $150,000 in startup and early stage finance operations. It's fair to say from our experience also that business angel networks feature very highly successful self-made entrepreneurs who look to acquire shares in potentially lucrative early stage companies to use their own funds. And it's fair to say that it's more than money. Quite often they bring their expertise to the table in terms of mentoring, which is invaluable. Now, it's also important in the context of private equity investors that you're aware of the Government Enterprise Investment Scheme, EIS, which provides key tax relief to investors who invest in business that meet specific criteria. And EIS, without doubt, is very attractive for investors investing if the legal entity can qualify for it. Now, peer-to-peer loans is becoming a little bit more popular, certainly at present. And what they really are, they're lending platforms. For example, some of you may have heard of Funding Circle, and they arrange loans from groups of individuals or organizations to entrepreneurs looking to grow. And it's a way for a business to get funding without having to visit a bank. And lenders can use the platform then as a marketplace where they choose who they want to lend money to. Now, on the other hand, crowdfunding portals, they offer a wealth of lending opportunities for startups and entrepreneurs. And they can basically, you pitch on a crowdfunding website for a sizable investment in your business model with the ability then for multiple investors to invest small amounts towards achieving your final funding requirement. Yeah, it's certainly becoming more popular. And in terms of alternative sources of finance, there are, you look at the Invest NI access to finance strategy, you obviously have equity funds and you have loan funds. And I stress there is quite a lot of detail in these specifically in the slides that follow, and you can follow this up in your own time. But sufficient to say that in terms of the equity funds, you have 3 core equity funds in Northern Ireland. You have the TechStart NI fund, 30 million fund supported by ERDF. And it basically is for investments between 50 and 2 million. You then have the Co-Fund 2 fund, again supported by ERDF managed. These are all ultimately influenced under the umbrella of Invest NI, a 50 million fund, and you can see it's for investments between 150,000 and 1.25 million. And then you have the Crescent 4 equity fund, again supported also by ERDF, 54 million fund, and you can see it's targeting investments of between 500,000 and 5 million. In terms of loan funds, which are very attractive in certain instances, you have the Small Business Loan Fund, which basically is an 8 million fund, and it provides loans between 10,000 and 100,000. You have the Growth Loan Fund, also supported by ERDF, and it provides loans between 100,000 and 500. And finally, you have the Growth Finance Fund, which basically is a £30 million fund. Some of you again may be familiar with White Rock Capital Finance, who are involved in delivering this one, and it's between 500, loans between 500 and 2 million. All very attractive depending on the specific circumstances of a business. Now, I'm not going to go into them here, but you can see there is specific detail in the slides, and you can go back if that's of interest to you and reference it. I think the more important thing is to just to pause for a second and to look at the key criteria that all funding providers are looking for. I mean, they're looking for you, first of all, to clearly identify the level of funding required and for what purpose. They're looking for you to demonstrate an ability to repay borrowings if that's applicable. They're looking to see, is your business case realistic? Is there growth potential for your business? I mean, they're certainly not there to fund businesses that weren't viable before COVID-19. They're not the funder of last resort. That's a restructuring proposal instead. And certainly, they're looking at you, the project promoters. Have you the ability to deliver the project? Have you suggested in the past through other actions you've done that you have leadership ability, that you have innovation ability, you have entrepreneurship ability? And there's some very fundamental principles in funding that really you have to be aware of. And it's amazing how often, whenever something goes wrong, it's actually the businesses appear to lack the knowledge of these fundamental principles, which are you borrow for long-term needs with long-term debt, and you borrow for short-term needs with short-term debt. And you match the term of the loan, the lease, or the HP agreement, asset finance, over the expected useful economic life of the asset. So you don't go out, if you have an asset that has an expected economic life of, say, 10 years, it costs 100,000, it would be madness to use your bank overdraft. And personally, I also believe madness to use your own cash reserves to buy that asset. You're better using asset finance and leaving your reserves, your overdraft, to fund what they're there for, short-term and working capital requirements. Now, it's fair to say that even in this difficult economic climate, the banks, albeit acknowledged, supported by the COVID-19 assistance from government, and this is where obviously Mark will come in, the British bank, but there is no doubt about it. Banks, the core banks, are funding business at present with the assistance of the government. So, why is cash flow management essential? Why are we in this webinar today? Well, it's fundamental because if you think about it, COVID-19 has caused a significant disruption to cash flow, whether it be decline in current and future sales, anticipated sales, whether it be issues with debtor collection, reduction in suppliers' credit, increase in costs for materials due to supply issues, increase in costs due to a necessity to facilitate social distancing requirements, etc., foreign exchange volatility, we could go on, delays, etc. So unfortunately, COVID-19 is causing major cash flow issues, and cash flow management by its nature helps to navigate the way forward. And when there's a crisis, there's no doubt about it, the first issue you go to is immediately your cash flow management. And it helps particularly to chart the way forward in the next 6 to 12 months. It helps to ensure the business is protected and able to recover quickly post the COVID-19 pandemic. And it ensures that you only borrow what you require and you're able to service. Please remember, in terms of borrowing, you have to pay it back. It helps you honor commitments to suppliers and employees, and assists in planning the right combination of the various government-backed lending and indeed grants that are available to businesses. And it certainly assists in terms of planning various scenarios, including further limited disruption periods for your business. Now, before we get into cash management, just briefly, it's important we understand the interpretation of financial statements. Now, there are 3 core financial statements that you'll hear people talk about. There's the profit and loss account, there's the balance sheet, and there's the cash flow statement. In terms of the balance sheet, what is a balance sheet? A balance sheet is a statement at a point in time, any day. Today, 15th of May, your balance sheet is just a summary of your assets, your liabilities, and your net asset or your net liability position. It's a statement at a day, point of time. On the other hand, if I got £1 for every time somebody said to me, when I said to them, when I was reviewing their annual accounts, perhaps they had a tax bill or whatever, they said to me, "Are you sure I made a profit? I have less money now than I had at the start of the year." And the reason for that is that there is a clear difference between profit and cash. Profit is the difference between the total amount your business earns, generates, and all of its costs. So all revenue minus costs. And it's usually assessed over a year, or it could be over, to be honest with you, over any trading period. On the other hand, cash is the amount you have on hand today. No beating around the bush. What you have access immediately to pay your debts if you have to pay them. And you can be showing a good profit, and sadly I can tell you I've come across this too often, where businesses have showed a good profit, but they're strapped for cash to cover immediate debt. And remember, if that happens, that you can't meet your liabilities as they fall due, you're then potentially going out of business. So working capital management is the key to influencing cash flow management. So let's look at another case study, very simple one. Two companies, company A and company B. Please be conscious that the same sales is 100,000. They have the same cost of sales, 80,000. They have the same profit, 20,000 for the year. And believe it or not, they have the same net assets, £20,000 of net assets. However, let's just look carefully at their working capital policy. No cash sales here. These are all trade sales. So in company A's case, they had £100,000 of sales in the year, and believe it or not, they've recovered £40,000 from their debtors, and they're still owed £60,000. In return, in terms of their cost of sales and creditors, they've actually paid £30,000 of the £80,000, and they still owe £50,000. And the net effect of that is that they have £10,000 in their bank. Now, if we look at company B, what have they done? They have only recovered £20,000 from their debtors, so they're still owed receivables of £80,000, and they have paid £50,000 of their cost of sales to their creditors, so they only owe the remaining creditors £30,000. Have a look at the bank, the cash flow position here. It is fundamentally different. Company A has £10,000 in its bank, and company B has a £30,000 bank overdraft. So that highlights the difference in cash flow and management and the importance of working capital management, debtors, creditors, and inventory. So cash is the lifeblood of any business. Quality internal management information, cash flow forecasts are vital. I mean, if for some reason you've slipped in the quality of your internal financial information, well, you need to get that addressed immediately, because no funder, because it makes good business sense for you too, is going to help you if you don't have up-to-date management information. And try and move from focusing on what credit the banks will provide the business to ultimately generating cash within your own business. This will take time, particularly in the Covid-19 environment. And you really should endeavor to be as less dependent on other funders as possible. That's become self-sufficient. And you know, we in our organization, we talk about that when we're advising clients with the 4 R's, which is robust, rigorous, and regular reporting on cash flow. If you do that, daily bank recs, if that's possible, certainly weekly, and definitely monthly forecasts. Really important. And you know, there's no hiding. You can't bluff. That tells you exactly who you are from a cash flow position. Self-discipline and good management, I promise you, will yield positive results. And it will improve profitability, believe it or not, but it will also significantly reduce your cash risk exposure. So, what really are the 3 elements of the working capital cycle that absorb all this cash? Well, the 3 elements we talked about in our last case study. Believe it or not, they're debtors, that's your receivables. They're creditors, that's your cost of sales, the people you owe money to in operating your business. And finally, a very important one is inventory management. Inventory, we talk about a combination of either stock or work in progress, depending quite often on the nature of the business. So, it's also important to recognize that there are 3 core components of cash flow management. And it's very simple. It's cash in hand at the beginning of the period. It's monies received and spent during an ensuring period. And it's the cash you have at the end of the period. You can't bluff. You either have it or you don't have it. So cash management is basically, you think about it, speeding up the inflows, speeding up the receivables, trying perhaps to get less people to take sales on trade and pay immediately up front, and slowing down the outflow, slowing down the time you've got to pay money. And we have to accept this reality that income and expenditure, cash flows rarely coincide. But you must always be in a position to meet your scheduled payments when they fall due. And this means there can be times when you could simply not have enough ready cash to meet your commitments unless you plan in advance. Now, you can summarize this in this table, and I think it actually is probably good to see it in a visual context. If you think of your cash flow reservoir, that's the money coming into it. Well, it can only come from one source, two or three key sources, which are identified here in 2 boxes. One, it comes from the revenue you generate from selling your product or your service. And secondly, it comes from either your own resources, either from grants or from borrowing capacity. It's as simple as that. And then where does it go? Well, you spend it actually on your operating activities to produce your revenue in the first place. You spend on your overhead, your operating expenses. You pay the tax man. You buy capital expenditure, plant and equipment. You pay financial costs such as interest. And ultimately, hopefully, you're able to pay yourself some drawings if it's a partnership or a sole trader, or in the case of a company, some dividends. Now, it is important to understand that cash flow problems or insufficient working capital can happen very easily, and we need to be aware of how that could happen. It could happen from a collapse in the economy, which COVID-19 is causing at present. It could happen due to insufficient funding, unplanned growth, poor credit control. Unfortunately, that's within our own control. That's bad. Internal trading problems, if that's relevant to your business, and under trading, which many businesses are experiencing at present. You're not able to trade at the capacity you'd like to, or indeed over trading. And that's basically where you put an emphasis on sales at the expense of profitability or cash flow. So to improve the cash flow, we need to look at the drivers of cash. And that's the four things we talked about, or the three things we talked about: debtors, creditor stock, then your ultimate assets, and then finally cash trading patterns and volumes and cash flow forecasting. Now, it's fair to say there are 5 steps really in terms of effective cash flow management and forecasting. And we're going to cover these very briefly towards, in reality, towards an actual bank proposal. But the first one, establish the starting position. The second, which obviously, where are you now, your baseline, and getting together all the facts as of now. The second one is about outlining your priorities for future trading. The brand is very important. Let's be fair. If you don't have a brand, you have a problem. Brand is what people are willing to pay for the premium to get your product or service. Investigate the supports available, very important. You need to research all the supports available, both grant and not for grant, and discuss that with business advisors or accountants, etc., or with your InterTradeIreland advisor, or indeed your Invest&I or your local enterprise agency advisor. Then we come to the actual cash flow forecasting itself, and that's where you create the forecast of your inflows and your outflows for each interval. And again, we'll cover that shortly. And finally, you implement and monitor. I cannot stress how important this is. This is where basically you closely monitor actual performance against forecast, look at your assumptions, look at the changing business environment, have an agile model, and changes as accordingly. And just before we approach the bank, I think there's a few points to note. First of all, banks are keen to work with existing clients and build a trusted relationship, and obviously secure new clients as well. But a sensible mix of debt and equity is important. And it's really important to be fair to banks, to understand, and don't waste their time. They're not there to take an equity risk for a banking return. This is back to the risk and reward analysis we highlighted earlier on. And banks, certainly in the current environment, in our experience, have been very good, but, and it's a big but, they will want to see the project promoters accepting some payment. I've also got to say, in personal experience, I believe your first chance is your best chance, and rather than rush to the bank, I would strongly recommend you pause, give a thought, and then prepare your bank proposal. And, as we've said before, they're going to look at a commerciality and reasonable check. Does it look reasonable? Does it look reasonable in what's going on? Again, in terms of the bank proposal, because we're trying to walk you through a bank proposal here, again, these are the headings that we think will be necessary to prepare. And personally, if I'm writing a bank proposal, believe it or not, this is what I do. I actually write down the headings that I think are relevant. I think once you do that and write on a sheet of paper beside you, it's a lot more easier then to get the right information in a concise way, because concise is important. Big documents are relevant. Concise is important.
Fergal, I'm very sorry to interrupt you there for a few seconds. We just seem to have lost audio a wee bit. If you could basically try and just repeat that section again.
Okay, well, all I was saying was, Caroline, that on the index, I think what happened was I think somebody maybe came in to try and ring me through an email or something. But what actually I was simply saying was that I personally find, in terms of preparing a bank proposal, that the best way to do it is to write down a sheet of paper on maybe your left-hand side, the headings that you're going to put in the structure of the bank proposal. And then it's very easy to be concise in terms of the content you actually put into the bank proposal by focusing on the layout and structure of the headings. And we're then going to go through each of these headings quite in more detail. In terms of executive summary, you would highlight the highlights of the business, its key strengths, and why under normal circumstances it is a good business to support. In terms of, it also is very important you state the reason for the funding. This is basic stuff. Believe it or not, you'd be amazed if how often I've read an executive summary in a bank proposal, and I still really don't know what is the funding requirement, what's the nature of it, how much do they need, and why do they need it, and what's the long the period. Highlight if you wish to secure bank debt, if you're planning to use the COVID-19 bounce back scheme, or indeed the coronavirus business interruption scheme, etc. They're all very important to highlight. And then where possible, indicate the serviceability, your ability to repay the loan, and provide a table of current and proposed new bank facilities. Provide details of the security available to the bank if that's relevant. Now, obviously, in both the bounce back and the business interruption loan, there are government guarantees. Obviously, 100% of the bounce back, up to 50,000, and up to 250,000 on the Corona business intervention loan. So if you're going above that. In terms of the business overview, very simple, a brief overview of the business operations and the market in which the business operates. Where relevant, and this is important, provide details of any changes that are taking place in the management of the wider organization as a result of COVID-19. Certainly highlight the management expertise, roles and responsibilities, obviously subject to the bank's existing knowledge. And any additional relevant background to the proposal, this is where you would put it in. Now, in terms of the coronavirus itself, let's highlight the key issues that the business is experiencing as a result of the coronavirus. Identify the risks, staff, payroll, etc., supply chain, customers, and try and then impact that on the various areas of your business. Now, in terms then specifically link it to the key risks and what you have done, very importantly, what you've done so far to mitigate and manage the cash flow to date for your business in the evolving coronavirus context. And again, have you availed of obviously the rates holiday? Have you been able to defer your VAT, your PIE, etc.? Have you been able to defer any of your HP or asset finance or mortgages? Have you got extensions from creditors, suppliers? Have you used the Corona job retention scheme, etc.? Have you furloughed staff? In your case, the self-employment scheme, the relevant one? And you're doing the various grants, the 10 and the 25,000 grants, etc. And obviously the hardship fund, which the details are yet to come, specific details. But they're all very important that you cover those impacts. And you then describe the cash flow constraints and challenges that are arising as a result of COVID-19. And you detail any actions, as I keep saying, really, really important that you've been taking and plan to take. And look here at scenario planning, the options as well that you have. Now, moving back to historic financial position, this is actually quite basic. And you'd say, God, how do you think we're stupid? Believe it or not, whenever we're under pressure, we don't think clear. This is what it means, historic financial information. It's very simple, but you've got to make sure it's there. Your most recent annual financial statements, your most recent management accounts, your most recent updated debtors and creditors listings, and ideally statements if you have them, your current bank facilities, and a brief commentary on the historical performance for any unusual items to demonstrate historic profitability, debt serviceability, and the strength of your balance sheet. We then move on outlining your business case going forward. Thankfully, we don't know exactly when, but we do know the COVID-19 pandemic will be temporary, and we must plan to be in a position to have a potential sustainable business going forward to exploit the recovery when it comes. And from a business perspective, I already touched on what I personally believe is key, the 3 R's: the reset, the refocus, and the rebound faster. As they say in our part of the world, you make sure you have fire in your belly. You want to exploit the opportunities that are there. And that's a really important point. Highlight new opportunities you think that may be a result of. How are you planning to address the social distancing? What costs, what resources? I mean, if you think about potential change in customer profile, if you think of, say, for example, just adopt the tourism sector for a second, less international visitors are expected certainly over the next 18 months. Perhaps there's opportunities for staycations, there will be. What are you going to do to try and attract that market? How are you going to use the natural assets of the country combined with your particular business opportunity? And you're also going to see, obviously, an increasing desire perhaps for leisure, certainly a bigger demand or focus on health issues, healthy diet, etc., and potential changes in food. So these are all things you look at. One of the other things that research is currently showing is the belief that the demand for greater 24/7 services is also going to rise, and that will obviously tie into remote working. It'll tie into businesses having to extend their opening hours to facilitate social distancing, etc. It's also fair to say that the younger generation are less fearful, and perhaps they'll be more willing to move quicker in terms of consumer expenditure in the short term? And again, can you target that particular sector of the community? And obviously strategic alliances, etc., will be important. Now, I don't want to go into all the stuff here, what you put into your assumptions, but it's reasonably straightforward. But your assumptions to your financial projections are fundamental, but they have to be achievable and realistic. And you go on under the various headings as highlighted here in the slide, and you explain what you're doing in your model. And then your model yourself, very difficult to do this in the course of this type of webinar as opposed to a workshop, but your model yourself, you look at this particular cash flow, and again, it'll be on the slides later, you can see what's happening here is, in this case, this company is experiencing in April and May, right through, it's now starting to trade, but right through to June, July, right on to December 2020, before actually its cash receipts start to exceed its cash outlays. But then it's starting, and very importantly, in the period of projections, you always will have to demonstrate you believe the business will be able to get back to a positive cash flow, positive profitability and sustainability, and be able to repay its debt, etc., and have a viable, sustainable business going forward. And one of the other issues I should have mentioned was the whole area of sustainability and green issues are coming more and more to the front, the environmental issues. Again, I'm not going to go through this now, but suffice to say, in your own time, you can see it on the slides on the website. So it's also important in terms of cash flow forecasting, some basics. You have to say, what is the forecasting interval? Is it a week or a month? In most cases, if you can do it monthly, it's probably easier. The software and the models are better for monthly. And you've got to familiarize yourself with forecasting tools, for example, like Microsoft Excel, etc. And simply, the more important thing then is to realize that you have to look at every aspect of your business in your financial cash flow forecasting. You got to look at your operating, which is your sales and your cost of purchase, etc., your operating costs, then your financing, your loan repayments, etc., your interest repayments, and finally your investing, your maintenance, and your proposed capital expenditure going forward. Particularly IT, technology could be major. Digitalization, if you're not already in a major digitalization program, obviously going forward, with very few businesses that can survive without one. So I said earlier, and I come back to it again, you then need to, in my view, rather than wait for the bank to assess it, you need to have within your own bank proposal a little bit of financial forensic analysis. And again, you look at sales trends, you look at your gross profit margin, you compare these to the sector and to benchmarking, and you would comment on why you believe your projections are correct. And, again, there's a number of tools that most funders, certainly banking organizations, will use the very minimum. It's very useful for you to calculate these yourselves and put them in your own bank proposal, such as the times interest cover, which is your profit before interest and tax over the interest. What that really means is it highlights the level your profits can fall before they're not able to pay interest to your cash profits. Then you have the debt service capacity ratio. Again, is your add back depreciation, which is not a cash item, under your profit before interest and tax, and you look at your loan and your interest commitments. That's your capital commitment as well. That's your interest. Then finally, you look at your leverage percentage, which again, you can see the definition there. And finally, above all, you may hear people talk about loan to value. Loan to value is your total debt facilities over the value of the security or the collateral that the funding institution holds in respect of your specific debt. So, in terms of sensitivity analysis, then you can decide what you think is most sensitive to your business at present. Is it a delay in the commencement by 2 months, or a delay in the scaling up of it? It could be sales or anything else, wages or whatever. But you do need to give that a bit of think relevant to your own business. Now, we mentioned about the factors that really affect cash flow, and obviously credit control and debtors management is one of those key working capital issues. And you should try not to give credit if possible and get obviously paid up front. You can see, sorry about Ian. There's a typo there that should be paid up front. Good credit control is all about systems. And companies, in terms of debtors management, if you consider it the money is due from your debtors, all the better. And there are a few simple steps, such as agree your business terms, establish credit practices and adhere to them. Monitor debt outstanding per customer, keep it on very close, maintain regular contact with the customer and the client to get paid, offer as much as you can to get paid, whether it be backs details, whether it be credit cards, etc., provide maybe incentives for early payment. You may also, if it's appropriate, look at a reservation of title clause for your business. And really what that means is that you continue to own the asset, even though you've transferred it via sale to somebody else until they pay for it. Now, again, that needs legal advice and only specific to certain industries. We also mentioned there, you can see invoice discounting, very, very important. And in this regard, sales credit insurance is also important to consider. So some potential bad debt indicators. If a customer is starting to take longer credit terms than is approved, the next one is fundamental. It's so simple. If somebody's paying you post-dated checks, the reason they're doing this is they can't afford to pay it all in one go. That's a warning sign. Equally, if there's evidence you think of your customers moving around other suppliers similar to you, then be careful about that, because quite often that's somebody who's having cash flow problems and they're trying to get credit from 3, 4, or 5 different suppliers. New customers who are reluctant to give you credit references. I would have a golden rule there. I would rather have no business than be a busy fool. If somebody's not willing to give you a credit reference, move on. And the other final one, keep your eye out for, is somebody paying you lump sum payments, regular lump sum payments, rather than an individual invoice. That's because, again, they're trying to keep the wolf away from the door. So be conscious of those warning signs. In terms of purchasing, I think the most important and credit control thing to observe is to get a hand on who authorized purchasing. You know, is it tightly managed, or can every Tom, Dick, and Harry in your organization ring up and order something? It's amazing how much you can tighten up your exposure and your cash flow by getting on top of who authorizes purchasing. Obviously, you can shop around and try and get value. Making prompt payments and get discounts for that as help. The possibility of consignment stocks is where a supplier is willing to provide you with stock, but you don't sell it, they take it back again. And obviously, from the other side, the reservation of title. Stock and inventory management, really, really important. You know, again, there's certain things you can do here, depending on the nature. You can be carrying out, if you're in the bar trade, you can be carrying out stock takes every week, but you know, depending on manufacturing, perhaps monthly or twice a year. But you got to know in your own management concept and culture the number of times each major item of stock is turning in a year. You know, the faster you can turn it, then the less cost you have of holding it, and security and all that, and space required. Very important. In my honest view, consider selling outdated stock or slow moving stock, because I think it gets more difficult to sell as time goes on. Now, again, there's a few exceptions to that. In terms of inventory management, consider indeed, and this is becoming very popular, having part of your product outsourced to some other manufacturer rather than yourself make it. And obviously benchmark yourself against similar businesses. Now, if you're in the service sector or indeed the manufacturing, but particularly the service sector, work in progress management is perhaps the most important factor, converting work in progress to fees. And you know, one of the things you got to create is, it's very busy, it's very easy to have busy staff, but if they're busy doing 10 or 12 different things, they get no fees out at the end of the week or the end of the month. Unfortunately, they're not doing any good to you. So I always say to my own colleagues, to be honest with you, I give no brownie points for work in progress. None. I give brownie points for fees issued and fees paid for. So basically, you've got to always be trying to focus on minimize your work in progress to convert it into faster invoicing and payments. It's fair to say that cost cutting will happen around this time, naturally, but make sure you're making the cuts from the fat and not from the muscle of your business. You know, the worst thing I can hear somebody saying is, "Oh, in a meeting, we're now cutting all costs by 30%. To be honest with you, excuse my English, that's bullshit. That is really bad leadership. That is fudging the matter. You need to go right in and see what costs should be cut and what costs should not be cut. Some costs should even be increased in the changing market environment you're in. Keep your overheads obviously under constant review. Have the courage to discontinue some costs if they're no longer consistent with your re-engineered goals and plan going forward. Currency management, again, I don't go into it again today because it's a subject matter of its own, but just highlighting that you must be very conscious if there is currency exposure within your business to manage it, because it can have a major impact on cash flow. So some practical tips basically. Before you borrow, you've got to consider short-term encouraged payments to debtors, etc. You've got to look at the period of funding. And you can see these things are all quite common sense, but they do require a little bit of thought. Now, if you have an inability to honor your commitments, and that can happen to any of us from time to time, there's a few things you can do very quickly. You can speak to your banks, to HMRC, to your creditors. Our experience is that if you speak to people in advance, 9 times out of 10, a solution can be reached out. Explore obviously options for deferring or restructuring debt. Involve your business advisors. Regular communications with your creditors, and you know it's back to taking some pain yourself, deferring some dividends or creditors or whatever. But it's common sense; it can be achieved. So, if you're fortunate enough to have surplus cash in these days, again, be very careful. Try to ring fence it. Perhaps even take somebody out of the business, so if the business goes under, you don't lose everything. But particularly take advice from an independent financial advisor if you have a lot of spare cash. So it's important, just before we conclude, to say that the cash flow and the working capital process must be inherent and interwoven throughout the entire organization. Everybody must be thinking cash flow, working capital every day of the week. And that's why the KPIs are very important to keep that going. And we find that if you share and talk about the organization's working capital and personal goals with the people you're sitting alongside every day, that then actually gets bigger buy-in, because it also creates certainty and clarity. And really, it's all about getting teamwork, everybody working together. So to conclude, really, the overarching principles: cash is critical, but to be fair, it's like everything else, you can't go to one extreme without balance. It is critical, but saving the business is even more important. So get your priorities right, shield your core ideas, business structures, relationship, peoples, and brand. Remember, business, indeed life, in my view, is all about people and relationships. Get the talent management right, and everything else most likely will go correct. Be agile, adapt to changing circumstances, and be decisive. You know, personally, I believe I'd far get on with something, make a mistake, and go back and correct it, and keep thinking about how I'm going to do it. So I think we've covered these. I don't plan to go into them before, but they're on the slides. Preparing a pitch for finance, the do's and the don'ts, and you know, certainly don't be too aggressive. Build in headroom if it means more equity in the business. And remember, banks aren't there to take equity risks. So to conclude, it's fair to say that we carried out a pulse survey last week as part of our InterTradeIreland webinar, and it suggests that 24% of non-Ireland businesses had access to COVID-19 bank support initiatives. Now, I have to be honest, that's slightly disappointing, because the corresponding figure in the Republic of Ireland was 79%. And maybe our other guest speakers in the panel today, Geoff and Mark, will be able to confirm that there has been a significant increase in take-up during the past 7 days. Now, we are currently experiencing unprecedented uncertainty due to COVID-19, with an economic recession, to be honest with you, forecast for the island, and a global world recession. We're currently attempting, obviously, to weather the storm, but going forward, we need to move into transformational mode. We need to explore the opportunities that arise. We need to change to focus now on strategic positioning and deliver a sustainable business. And that's obviously what we'd like to focus on in our next seminar next week. But hopefully today's webinar on approaching banks and managing working capital and the importance of cash flow will help you in your forward journey. Thank you for joining me, and we now go back to Caroline, and I'm looking forward to a proactive and inquisitive Q&A. Caroline, back to you.
Thank you so much, Fergal. That was really clear in layman's terms, and a lot that businesses can take away and action. There are a few questions coming through, but before I open the floor, I'm going to ask all our panelists to come on camera and come on mic. And while we wait for our panelists to come and join us, can I remind those of you who are joining us today that if you have a question as we go through our questions, you can also just raise your hand, which is a button at the bottom of your screen. So let me introduce you to who's joining Fergal today, Fergal and Shane. We have Michelle Hawkins, Head of Advisory from PKF-FPM. Joining her is Aimee McShane, she's our Senior Advisory Manager. Also have Geoff Sharpe, who's the Head of Corporate Banking in Danske Bank, and Mark Sturrett, UK Network Director of British Business Bank. So we're going to start off. Our first question is from Fintan. Fintan, I have enabled your mic. Do you want to unmute and ask your questions to the panel?
Yes, good morning. I'd be interested to know, given that the number of small businesses that we have in Ireland and across the country in general, why the British Business Bank set accumulated losses as being a key criteria within the business and difficulty eligibility criteria aspect. It's something that is becoming extremely frustrating for a number of small businesses that we have spoken to. And then the second part of my question is that the partner bank that we're using, I don't want to be specific, but they are basically saying, which is in complete contradiction to what Fergal had said, that they are not going to consider any future cash flow projections and the ability to repay any loans. So I kind of two questions there.
Mark, go ahead.
Straight to it. Thanks for the questions, and they're good questions. I suppose I'll look at it in two different ways. One, to reiterate something that Fergal did say in his talk, was these products that the British Business Bank are running on behalf of the British government are loan products. So obviously they are debts being taken on by the business, and they would be expected to repay them as opposed to a grant. So serviceability and viability has to be established as part of that assessment. The issue about the business in difficulty, that links directly, and I'm going to surpass to some extent because I don't have the detail, but it links directly to state aid implications in terms of the nature of the scheme, how it was devised and written with the European Union at the outset in its design. So that there's a reason for that, and it's linked directly to the state aid obligation for it. The question around the removal of projections, and again, it comes back to set it in the context of this being a loan product as opposed to any other type. When the scheme was first launched on the 23rd of March, there was a requirement for a business to produce projections, or for a bank to be comfortable that the business could come out of the current situation and trade through and repay the debt that they were taking on as part of CBILS. And the feedback came back from both lenders and the SMEs that wasn't viable because projections in the current environment were so difficult to actually put together and rely upon. So the requirement was taken away because it was causing delays in the process. And now it's up to the bank to decide, was this business fundamentally good going into this crisis, and therefore applying your normal lending criteria, do you believe that they could be re-established and trade out again in the context of the debt that they're taking on? So that's the rationale for the removal of the projection piece.
If I maybe just add to that, add to what Mark has covered there as well, I suppose from the bank's perspective. And Mark is absolutely right. The approach that I suppose the practical approach that we are taking within the bank is that we're almost saying to a borrower or a customer, when they're presenting their pack of information to the bank, you know, we're very sympathetic in terms of the last 4 or 5 weeks in terms of cash flow impact. So almost set that aside, and we're looking at the cash flow profitability of the business prior to COVID, and if the business could service the additional level of debt required under the CBILS support scheme, based upon its cash flow prior to the last 7 or 8 weeks, then we're effectively considering that business to be a viable business. So I think that's a really important point that I suppose for a borrower or for any business, you know, considering coming forward to their bank, it's almost a case of setting aside the impact of the last 6-7 weeks, because look, in a lot of cases in a lot of businesses, revenue lines went from X to 0, depending on the sector that it's in. So we're really looking at the performance, cash flow, and profitability of a business before that, making an assessment as to whether the business was a viable, strong business before COVID, and will it get back to its pre-COVID level again. And if generally we're comfortable around that, then I suppose the business is viable, and we'll assess the repayment capacity for any CBILS loan against its likely future levels of revenue at a level that would have been evident pre-COVID.
Certainly add one further question there. If you want to stand out and differentiate yourself from other people in the field, if you want to show that you really have a business that's worth backing, and more importantly, you're coming back all guns blazing, albeit perhaps in a step approach, I would say by not providing a smart, concise cash flow forecast, you're doing yourself no favors. Even though the scheme may not require it, but you're doing yourself no favors.
Okay, thank you.
Sorry, Mark, just to come in there, in terms of the accounts to present, you know, are you looking up-to-date management accounts, just so people are aware?
Again, sorry, I didn't catch that. I'm looking for
up-to-date management accounts. You know, many businesses mightn't, you know, have that. Yeah,
really, the way the scheme works, there were 40 lenders accredited when it went live, and there are many more accredited now. The nature of the scheme is that each lender applies their own lending criteria. So whereby one might say we require bang up-to-date management accounts, some might require audited accounts. So Geoff could certainly speak for Danske in their regard, but it's really down to each lender's appetite to how they would assess that.
Yeah, from our perspective, it's I suppose very much a case of the size of the business. So I suppose the overall point is that the level of information that we will look for from a borrower is reflective of the size of the business. So for a micro business, small business, where typically even cash flow requirements management accounts wouldn't have historically been provided, we're trying to work with those customers on an information light basis, and in a lot of cases that information is being gathered on a telephone call or over an email. And then for larger businesses and corporates, like of course there probably is already sort of information covenant requirements around receiving management accounts. So as part of any CBILS application for a larger business, we will absolutely look for up-to-date management accounts. But look, to Fergal's point, which I absolutely agree with, you know, look, if there are management accounts or forward-looking projections available, they are of course going to help and support a case. But I think the important point is that, look, you know, that the level of detail required in those should be reflective of the business. So for a very small owner-managed business, you know, something by way of a one-page summary of level of income, level of cost to cover, and look, we have prepared support tools to provide to small businesses to help, and then obviously for a larger corporate or larger business, a lot of that information will be at hand anyway, and will be provided to the bank. So it's all reflective of the size of the business.
And if I may just briefly come in there again, I think to be fair, I think the culture is important here, and that the size of the business is fundamental. But hopefully today's webinar will give people, sole traders or otherwise, a broad understanding of the principles. And if you have an understanding of the principles, that's very important before you lift the phone and talk to the person else, because you understand where they're coming from. And it doesn't have to be a one-page document, can be brilliant in certain cases, but you have to understand what you're trying to achieve.
And that leads very nicely on to the next question. We have a number of people asking the same question, so I'll just read it out. How long are the applications taking, and are you finding that there's any common issues that you're finding that maybe our people could learn from? Geoff, do you want to take that one first?
Yeah, in terms of how long the applications are taking, so I suppose there's a couple of parts to that. So if you take, for example, the newly launched bounce back loan scheme, the small scheme for loans up to 50 grand, which launched last week, that certainly within Danske Bank, and I think for most lenders, is very much an automated process. So for us, it's a self-certified application form which the borrower completes. It's a 2-page form. It gets submitted to the bank, and the credit decision then is fully automated within Danske Bank. So since it launched last week, we've had over 2,000 applications, and they are being turned credit approved within a 48-hour period, and then the paperwork will go out to the customer once it's credit approved. Customer can, in a lot of cases, digitally sign the paperwork and get it back. So time to money is, you know, in some cases 3-4 days. And then for the larger CBILS and CL bills schemes, I mean, I suppose there at the outset of the COVID lockdown, there was a huge volume of applications which arrived with us. We prioritised those which were most in need. But as a general, I mean, a credit decision is typically being made from receipt of information within 3 to 4 days. And then depending on whether there's any new security to take or what paperwork needs to be completed, again, time to money should be within, you know, a 7 to 10 day period. So it is a very quick process. Many of the bank's standard sort of procedures and processes have been streamlined and shortened. So the typical credit paper, which you know, would typically be much longer, is now in some cases down to 3 or 4 lines. So it is a quick process.
Brilliant, thank you. we are slightly over our time, but I think it's important to have, say, one more question from the floor. Kathy's asked me to read out her question. Can an NI company with a 100% subsidiary of an ROI holding company access the CBILS scheme or loan?
Yeah, I'll take that one. Yes, they can. And an SME that's foreign owned can apply for CBILS, provided it is trading in the UK. So it's not just selling into the UK, but has corporations here. And we'll say there's a good set of FAQs on the BBB website that covers the CL bills, C bills, and bounce back schemes for SMEs, and do provide quite a bit of detail. But I can confirm in that case, yes, they can apply.
Thank you very much.
Subject to Shane, but I mean, I don't think we don't have a problem if there are people who may get questions. People can put them in writing, but if they want to actually specifically ask them, I think none of us have a problem taking them if they want to go ahead.
Absolutely. I would encourage anyone that has any questions there to do so. Yeah, please.
Wonderful. Well, on that note, I am conscious of time, so I'll bring our Q&A to a close there. Thank you so much for your time today. Firstly, to Fergal and our panel for your insights and for your guidance. I hope the audience will agree with me, a very worthwhile session. I also want to thank those of you joining us today. I hope that the session has been of help to you. I know, as Fergal and as Sheena said, that our experts will be more than happy to answer any questions on a one-to-one basis. We are back next Thursday and Friday for our final part in this webinar series, Planning for Recovery. Registration is open, and if you've missed part 1, financial support, you can get that access to that recording and a copy of all slides from our presentations on InterTradeIreland website, and I have put that link in the chat. So all that's left for me to say is thank you for joining us, stay safe, and we hope to see you next week. Bye for now.
Thank you, folks.